Good morning to all of you. So I think you are all able to hear me and see the slides on your screen. If anyone has a problem, please point out before we start today's session. So today we are going to first discuss events after the reporting period. We'll talk about adjusting events and non-adjusting events. We'll look at different scenarios, the treatment and accounting requirements under different scenarios, the disclosure requirements for events after the reporting date, and the difference between IFRS and US GAAP in this particular area. As you all know, the balance sheet date, the date on which the balance sheet is prepared, is the pivotal date at which the financial position of an entity is determined and reported. So the balance sheet date or the reporting date is the pivotal date at which the financial position of the entity is determined and reported to the various users of the financial statements. So the events that occur up to the date, the balance sheet date, are critical in arriving at the entity's financial results and financial position. So all events which occur up to the reporting date or the balance sheet date, they are critical in arriving at the entity's financial position as well as performance. However, sometimes some events occur after the reporting date, but before the financial statements are released or approved for release. So how to treat those kind of events which happen or occur after the reporting date but may have a bearing on the financial position or financial performance of the entity after the reporting date. So we will discuss about those kind of events which normally happen after the date of the balance sheet or the reporting date, but which may still have an impact on the financial position of the entity or financial performance of the entity after the reporting date. And these have to be, you have to make proper adjustments relating to those events which occurred after reporting date, or you have to make proper disclosure regarding those kind of events. So we'll talk about events after reporting date. It's a very important concept which may affect the financial reporting. So we are basically discussing one of the important accounting standard known as IAS 10. This is what we are going to discuss today. Objectives and purview of IAS 10. The objectives of IAS 10 is to describe when an entity should adjust its financial statements for events after the reporting date. Under which circumstances or when an entity should adjust its financial statements for events after the reporting date. And it is also, the purview is also described disclosure that an entity should give about the date when the financial statements are authorized for issue and about the events after the reporting date. So certain disclosures will also be required relating to events after the reporting date. So objectives of IAS 10 is basically to describe when an entity should adjust its financial statements for events after the reporting date, and also the disclosures that an entity should give about the date when the financial statements are authorized for issue and about the events after the reporting date. So IAS 10 should be applied in the accounting for and disclosure of events after the reporting date. That is what is the purpose of IAS 10 or scope of IAS 10. So IAS 10 basically provides guidance on accounting and disclosure of post-balance sheet events. These are called post-balance sheet events. For the purpose of this standards, post-balance sheet events are again categorized into two types, adjusting events and non-adjusting events. Which is, events can be classified events which occur after the balance sheet date, that is post-balance sheet events. They can be, under the IS 10, they are categorized into either adjusting events or non-adjusting events. The issue addressed by the standard IS 10 is to what extent anything that happens during the period when the financial statements are being prepared should be reflected in those financial statements. The standard distinguishes between events that provide information about the state of the entity at balance sheet date and those that concern the next financial period. So, the standard distinguishes between events which provide information about the state of the entity at the reporting date and those that concern only the next financial period. The secondary issue is the cutoff point, beyond which the financial statements are considered to be finalized. There should be a cutoff point. Beyond the cutoff point, all the financial statements should be considered finalized and no changes should be made in the financial statements. So this is the scope of IS 10. So we'll come to the categorization of adjusting and non-adjusting events. So we talk about events after the reporting date. Events after the reporting date are those events that occur between the end of the reporting date and the date on which the financial statements are authorized for issue. Some of the events can be favorable, some of the events can be unfavorable. So events which occur between the end of the reporting date and the date on which the financial statements are authorized for issue or release to the users, those events are called events after the reporting date. And some of these events can be favorable for the entity, some of these events can be unfavorable for the entity. So there are two types of events. One type of event that provides further evidence of the condition that existed at the end of the reporting period. These are called adjusting events. So one type of events or one category of events which provide further evidence of the conditions that existed at the end of the reporting period, they are called adjusting events. And for this kind of events, adjustments of the financial statements will be necessary. So first of all, we are considering events which occur between the end of the reporting date and the date on which the financial statements are authorized for issue. Of these events, some events can be favorable to the entity, some events can be unfavorable to the entity. Those events which provide further information about or evidence of the condition that existed at the end of the reporting period are called adjusting events, and for these events, necessary adjustments must be made in the financial statement. That's why they are called adjusting events. But the events that are indicative of the condition that come into existence after the end of the reporting period, these are called non-adjusting events. There will be certain events which are indicative of the conditions that come into existence after the end of the reporting period, for which no adjustments of the financial statement will be necessary. These are called non-adjusting events. So let's look at to understand what we mean by events after the reporting date. For an example, let's understand what is meant by events after reporting date. So reporting date is 31/3/2015. For an entity, the reporting date or the balance sheet date is 31/3/2015. On 31/3/2015, the books will be closed and preparation of financial statements should be undertaken. The preparation of financial statements may not be completed in one day or one night. It takes time to complete the process of preparing financial statements. Then these are going to be audited by the external auditors, statutory auditors. So some time is required. The time could be 1 month, the time could be 2 months. So once the financial statements are prepared and audited by the auditors, then these financial statements are put up to the board of directors or the management for their authorization. That means once they authorize, the financial statements can be released to the users. So financial statements are authorized by the board or the management, supposing that reporting date is 31/3/2015, and financial statements are actually authorized by the board or management subsequently on 15th of July 2015. During this period, any events which happen are called events after the reporting date. Any event that may be favorable for the entity or unfavorable for the entity will be considered as an event after reporting date. So the period between the end of the reporting period, that is 31/3/2015, and the date the financial statements are authorized for issue by the management. During this period, any event which happens or occurs which may be favorable or unfavorable for the entity would be considered events after the reporting date. Financial statements as approved by once the financial statements are authorized for issue by the board of directors or management, then the financial statements will be approved by the shareholders in the AGM, which may take place subsequently. So the financial statements approved by the shareholders in AGM may take place on 18th of August 2015. So you can look at the time, look at the concept, because it is 31/3/2015 being the balance sheet date. Yes, what is the question, Rituparna? Slide number 3. Okay, I'll go back to slide 3. Just a minute. Let me finish with slide number 4, and then I go back to slide 3, because slide 4 is basically illustration of the slide 3 regarding what we consider as events after reporting date. So let me finish it. Okay. So if the reporting date is 31/3/2015 and the entity starts preparation of the financial statement, gets it audited, like the State Bank of India. State Bank of India reported the balance sheet date is 31/3/2017. That will be the balance sheet date. The last balance sheet will be prepared on 31/3/2017. I believe next week, 19th of May possibly, if I am not wrong. 19th of May, this prepared and audited financial statements of State Bank of India are going to be placed by 19th of May. It will be just going to be placed before the board of directors of State Bank of India, and they will authorize the issuance of the financial statements. So on 19th May, I think there will be a press conference kind of a thing where the chairman of State Bank of India or other senior level executives, they will be declaring the results of State Bank of India to all and sundry, and then the financial statements are authorized for issuance to the shareholders and various other users. That is the time when the authorization is made. Now the financial statements are ready, audited, everything, but it has not yet been authorized for issuance by State Bank of India management. That will be done on maybe next week. So after that, State Bank of India will hold an annual general meeting. They will give a notice for the annual general meeting of the shareholders, where these financial statements will be approved through a resolution passed by the shareholders. Then that is, so whatever events are occurring between 31st March 2017 and the date of authorization by the management regarding issuance of the financial statements, those events are called events after reporting date. That is the definition. So I am going back to the slide number 3. The example is in slide number 4. I am taking you back to slide number 3. So please see the definition. Events after the reporting date are those events that occur between the end of the reporting date and the date on which the financial statements are authorized for issue. So if you want to let me know when you are finished with this slide, done with this slide. So are you done with the slide, Rituparna? Okay, thank you. So the authorization date is the date when the financial statements could be considered legally authorized for issuance. When the board of directors or the management approves, gives the authorization for issuance of the financial statements, that is authorization date. That is the date when the financial statements can be considered legally authorized for issuance. Before that date, the financial statements have not been legally authorized for issuance. They cannot be issued. So authorization date serves as the cutoff point after the balance sheet date up to which the post-balance sheet events are to be examined in order to ascertain whether such events qualify for the treatment prescribed by IAS 10. So Devala Monish, what is the question? Let me see. No, events after reporting date is not something adjustments given. What are the adjustments given below balance sheet at the end of the year? How it is below the balance sheet, what kind of adjustments you are talking about? We are talking of off-balance sheet items. If you are talking of off-balance sheet item, that is different. That is basically contingent assets or contingent liabilities. So events after reporting date has to be, so when we talk about events after reporting date, we will find some events are in the nature of adjusting events, some are non-adjusting events. For adjusting events, the financial statements have to be recast. So adjustment will be made in the financial statement itself. The profit and loss figure may be changed. Certain balance sheet figures may also undergo changes. So it is the financial statement itself will be the financial statement that will be put up to the management for authorization will contain those changes for events which occurred after the reporting date. So the financial statement itself will be adjusted. So it will not be, adjustment will not be by way of some adjustments given below the balance sheet. No. It will be the financial statements themselves will be adjusted for adjusting events. We are going to discuss it. So remember, we have talked about the cutoff date beyond which the financial statement should be considered as finalized. We mentioned that thing. In one of the earlier slides, we talked about so we talked of the cutoff point after the balance sheet date up to which post-balance sheet events are to be examined in order to ascertain whether such events qualify for the treatment prescribed by IAS 10. So if you don't have a cutoff date, what will happen? Events will keep on happening after the balance sheet date, and you cannot carry on changing your balance sheet or make more disclosures based on events which are occurring after the balance sheet date. You must have a cutoff point beyond which you will not consider the events which may affect the financial position of the company as on the reporting date. So the cutoff point is the authorization date. If any event happens after the cutoff point which still may impact the financial position of the entity as on the reporting date, that wouldn't be considered. So you have to stop at some point. So the authorization date serves as the cutoff point after the balance sheet date, up to which the post-balance sheet events are to be examined in order to ascertain whether such events qualify for the treatment prescribed by IAS 10. So the determination of the authorization date is critical to the concept of events after the balance sheet date. The general principles that need to be considered in determining the authorization date of the financial statements are: when an entity is required to submit its financial statement to its shareholders for approval after they have already been issued, the authorization date in this case would mean the date of original issuance and not the date when these are approved by the shareholders. Understand? When an entity is required to submit its financial statements to its shareholders in an annual general meeting for their approval, the financial statements have already been issued. The authorization date in this case would mean the date of original issuance of the financial statements and not the date when these are approved by the shareholders. Like the State Bank of India, as I give you the example, if 19th May the State Bank of India board authorizes the financial statements and these for issuance, and the financial statements are issued on that date. That date will be the authorization date. The annual general meeting of the shareholders may take place in September or October, and the shareholders may approve the financial statements at that point of time. But the authorization date for the purpose of the financial statement would be considered 19th May, the date on which the management authorizes the issuance of the financial statements. When an entity is required to issue its financial statements to a supervisory board, sometimes there can be a supervisory board. The entity is required to issue the financial statement to the supervisory board. Authorization date would mean the date on which the management authorizes them for issue to the supervisory boards. So some entity may be supervised by another entity, or there may be a board which is supervising that entity. It is not necessary all entities will have shareholders, or they have to approve these things to shareholders. So they may have to send it to a supervisory board. Now, when they send it to the supervisory board, the financial statement are issued to the supervisory board for their approval. The authorization date would mean the date management authorizes the issuance of the financial statements to the supervisory board. The general principle that need to be considered in these are the two principles to be considered while determining what is authorization date. If an entity is required to place the financial statements before the shareholders or to the supervisory board for their approval, the date on which the management authorizes issuance of the financial statements or the date on which the management authorizes issue of the financial statements to the supervisory board, or that will be the cut-off date, that will be considered as the authorization date. So all events up to that date would be considered, be examined to ascertain whether such events qualify for the treatment prescribed under IAS 10. So we are very clear on up to what point of time we will consider the events, post-balance sheet events. There is a cut-off point beyond which no post-balance sheet events would be need to be examined and given treatment under IAS 10. Now, as I told you, there are two kinds of events. When you examine the events after the balance sheet date, we can come across two kinds of events. One kind of events we call adjusting events. IAS 10. Basically, IAS 10 categorizes events after the balance sheet date or post-balance sheet events up to the date of authorization or issuance of the financial statements into two kinds of events. One kind of events are called adjusting events, the other kind of events are called non-adjusting events. Adjusting events are those events after the reporting date for which an entity should adjust its financial statements. These are called adjusting events. So for this kind of events, the entity needs to adjust its financial statements which have already been prepared. They are called adjusting events. Non-adjusting event doesn't require any adjustment in the financial statements. If these events are material, depending on the materiality of the events, then only disclosure will be done. So in the form of notes to financial statements or in the form of footnotes, it will be the appropriate disclosure will be made regarding those events. These are non-adjusting events. The financial statements will not be adjusted. The numbers will not be changed. But if the events are material, then obviously it has to be disclosed by way of a note to financial statements. So two kinds of events after the balance sheet date are distinguished by IAS 10. These are respectively adjusting events after the balance sheet date and non-adjusting events after the balance sheet date. Adjusting events are those post-balance sheet events that provide evidence of conditions that actually existed at the reporting date or the balance sheet date, although they are not known at that time. The adjusting events are basically those post-balance sheet events which provide evidence of condition that actually existed at the balance sheet date, although they were not known at that time. So if there is an event which provide evidence to the if there is a post-balance sheet event which provide evidence to the condition which existed on the balance sheet date but which was not known at the time of balance sheet, on the date of the balance sheet. So these are called adjusting events for which necessary adjustments must be made to the financial statements. So financial statements should be adjusted to reflect adjusting events after the balance sheet date. Typical example of adjusting events. Now you may be interested to know, can I give you some example of adjusting events? Yes. Say, customer has become bankrupt after the balance sheet date. A customer has been declared bankrupt. A bankrupt person cannot pay. So a customer of that company, very important customer of the company, another company maybe, another entity, they become bankrupt. They have been declared bankrupt by the court, adjudged bankrupt by the court after the balance sheet date. So the bankruptcy of a customer after the balance sheet date usually suggests a loss of trade receivable at the balance sheet date. So if a customer, supposing between the balance sheet date and the date of authorization, a customer has been declared bankrupt. So the customer would not be able to pay the trade receivables due from the customer. This would be a loss. But the fact that the customer has become bankrupt was not known at the balance sheet date. But when you come to know this, it changes. It is basically we come to know of a condition that some of the trade receivables from the balance sheet date would not be recoverable. Then we come to know. So for that we must make an adjustment. We must have to possibly recognize that loss in trade receivables by making appropriate provisions or booking the appropriate loss. The sale of inventory at a price substantially lower than its cost after the balance sheet date confirms its net realizable value at the balance sheet date. If some inventory is sold after the balance sheet date but before the cut-off point, that is date of authorization of the financial statements, and it is sold at a much lower price than what was reflected in the financial statement, then it becomes a adjusting event because the sale of inventory at a price substantially lower than its cost after the balance sheet date confirms its net realizable value at the balance sheet date was something lower than what was being reflected. So there is an impairment. Yeah. Similarly, the sale of property, plant and equipment for a net selling price that is lower than the carrying amount is indicative of an impairment that took place at the balance sheet date. The sale has taken place subsequently. Sale of property, plant and equipment for a net selling price which is lower than the carrying amount is indicative of an impairment that actually existed on the balance sheet, that took place on the balance sheet. So for this we have to make necessary adjustments to the financial statements. These are kind of adjusting events. Non-adjusting events, of course, are those events which do not indicate to a condition or do not provide evidence to a condition that existed on the balance sheet date. So those are non-adjusting events which are not known at that point of time. So non-adjusting events, basically what is not an adjusting event we can consider as a non-adjusting event. That means a non-adjusting event will not does not provide evidence to that a condition which existed on the balance sheet date for which necessary adjustment should be made. So non-adjusting events are basically no adjustment is needed, only disclosures if the non-adjusting event is considered material. So let's look at a case study or a particular problem to understand this better. One of the key customers with whom the company has $12 million of outstanding receivables reported huge losses and was unable to pay their dues. So the customer had suffered losses, business losses, and it was unable to pay the dues. This condition was known by the management on the balance sheet date 31st December 2014, and further orders placed by the customers were cancelled because the management knew that this particular customer has suffered business losses, unable to pay its dues, So they stop accepting further orders from the customer. This condition was known to the management on the balance sheet date. Accordingly, orders from the customers were cancelled. Further, 10 days before the board meeting was to be held on 26 February 2015, and the balance sheet date was 31st December 2014, so board meeting was scheduled on 26 February 2015. 10 days before that board meeting, the board meeting was called to authorize the financial statement. The board meeting was convened to authorize the financial statements. So on 10 days before that board meeting, the customer filed bankruptcy and settled only 25% to the creditor as final payment. The said customer filed for bankruptcy and settled only 25% to the creditors as final payment. So the bankruptcy of the customer happened after the end of the reporting period, but before the authorization date for the financial statement, which is 26 February 2050, so it's a post-balance sheet event. It confirms the condition that existed at the end of the reporting period on the receivables, that receivables need to be adjusted for a loss of 9 million in financial statement, because out of 12 million of receivables, customer is going to settle only 25%, that is 3 million. So 9 million customer won't be able to pay. He has already filed for bankruptcy and he is settled only 25% of the creditors as final payment. So the company, the entity will have to, now the condition existed on the balance sheet date, the fact that the customer filed for bankruptcy and settled 25% of the creditors as final payment became known after the balance sheet date, but once it became known, it indicated to a condition that existed on the balance sheet date, that the company is going to suffer a loss of 9 million. So the balance sheet, the financial statements has to be adjusted here. So this is adjusting events. So bankruptcy of the customer, which happened after the end of the reporting date or reporting period and before the authorization date of the authorization of the balance sheet or financial statement, it confirms the condition that existed at the end of the reporting period on the receivables, and it need to be adjusted for the loss of 9 million in financial statements. That loss should be adjusted in the financial statements. This is an example of events after reporting date requiring adjustment. Another example you can look at, ABP Limited has reporting date of 30th September. On 21st October, the largest of its production facility was substantially damaged in fire. It has got various production facility, and the largest of the production facility of ABP Limited was damaged by fire, substantial damage by fire, but after the balance sheet date, causing not only loss of assets but also faced non-production due to shutdown for next 3 months. Assets were lost due to the fire damage, but also the plant was shut down for next 3 months. Now this event, it's a material event, but it came into existence after the reporting date and no condition existed on the reporting date. The condition arose on 21st October. On 30th September, the plant was running fully well. There was no loss. Production was going on. So no condition existed as on the reporting date. Although the damage is a material, the loss of asset is a material event, shutdown of the plant is material, but no condition existed on that date, on the reporting date. Hence no adjustment to financial statement will be required here and only disclosure needs to be made. So when the financial statements are issued, by way of a notes to financial statement, this fact may be disclosed to the shareholders as a event of the reporting date, which may affect the future financial statements or future performance of the company, but it doesn't really have an impact on the performance that is being reported or the financial position that is being reported. So this is non-adjusting event. So I think these two examples are quite clear to just make you aware of what is adjusting events and what could be non-adjusting events and how they have to be treated. Now, dividends to shareholders. Sometime company declares dividend to shareholders after the reporting date, but before the authorization of the financial statements. So company may declare dividends to its shareholders after the reporting period. This should not be recognized as a liability at the end of the reporting period. This is a treatment regarding dividends. Any dividend declared by the company to its shareholders after the reporting period, it should not be recognized as a liability at the end of the reporting period. IS-1 requires an entity to disclose the amount of dividends that were proposed or declared after the reporting period, but before the financial statements are authorized for issue. So dividends declared after the reporting period is again a non-adjusting event, and IS-1, the other accounting standard, which is basically the guidance for preparation of financial statement, it requires an entity to disclose the amount of dividends that were proposed or declared after the reporting period, but before the financial statements are authorized for issue. So dividends on equity shares proposed or declared after the balance sheet date should not be recognized as a liability at the balance sheet date. Such declaration is a non-adjusting subsequent event, and footnote disclosure is required unless it is immaterial. Now comes another important concept called going concern, because as you know, the financial statements are prepared on a going concern basis. But if normally a financial statement or entity should prepare its financial statements on a going concern basis, but an entity should not prepare its financial statements on a going concern basis if the management determines after the reporting period. Supposing the management decides after the reporting period of the balance sheet date that it intends to liquidate the entity or cease trading, or the management has no realistic alternative but to do so. It may not have management determines after the reporting period that either it wants to liquidate the entity or cease trading, or if the circumstances show that the management has no realistic alternative other than liquidating the entity or stopping the trades. So it is an event after the reporting date. So an entity should not prepare the financial statement on a going concern basis. It is a normal basis for preparation of financial statements. If there is a situation where the management has determined after the reporting date that it intends to liquidate this entity or cease trading, or it has no realistic alternative other than doing so. If the going concern assumption is no longer appropriate, so in this case the going concern assumption will be no longer appropriate for preparation of the financial statements, the IS will require, accounting standards will require fundamental changes in the basis of accounting rather than an adjustment to the amount recognized with the original basis of accounting. So here it is a question of adjustments. This is a fundamental change in the basis of the accounting. We are now no more going to prepare the financial statements on a going concern basis. It is a fundamental change in the basis of accounting. It is not merely an adjustment to the amount recognized within the original basis of accounting. So the following disclosures will be required. A note saying that the financial statements are not prepared on the going concern basis must be there. So in the notes to financial statements, a note should be there saying that the financial statements are not prepared on the going concern basis. That must be there. The management is aware of the material uncertainties. The note will also say the management is aware of the material uncertainties due to events or events that cause significant doubt on an entity as going concern. So this kind of disclosures must be done. Number one, the entity's financial statements will not be prepared on a going concern basis, and that disclosure should be made by way of a footnote to the financial statements, and also that the management is aware of the material uncertainties due to events that cause significant doubt on an entity as a going concern. So we will talk about the difference between IFRS and US GAAP. So for us, post-balance sheet events are concerned. So first area is the relevant date for events after reporting date. As we have seen in IS 10, Subsequent events are evaluated through the date that the financial statements are authorized for issue. So subsequent events up to the date of authorization of the financial statements for issuance are evaluated or examined to see whether these are adjusting or non-adjusting events and whether it requires to make adjustment in the financial statements or only disclosure in the financial statements. So subsequent events are evaluated through the date that the financial statements are authorized for issue. This is the guidance under IAS 10. Under US GAAP, subsequent events are, that is ASC 855, subsequent events are considered up to the date when the financial statements are issued for SEC regulated entity or available to be issued for non-SEC regulated entities. So financial statements are considered issued when they are widely distributed to shareholders. So what is the date of issue? The date when they are widely distributed to the shareholders. Not when the shareholders are approving it, when they are widely distributed to the shareholders. Financial statements are considered available to issue when they have been complied, when they have complied with US GAAP and approved. Now second point is regarding reissuance of financial statement, whether a financial statement can be reissued. IFRS doesn't specifically provide for the reissuance of the financial statements. As a result, only one date is considered for subsequent events. The entity can adjust subsequent events in reissued financial statements. Only one date is considered for subsequent events. The entity can adjust subsequent events in reissued statements. If the financial statements are reissued, events or transactions may have occurred that require disclosure under US GAAP. If financial statements are reissued, events or transactions may have occurred that require disclosure in the reissued financial statement to keep them from being misleading. However, an entity should not recognize events occurring between the time the financial statements are issued or available to be issued and the time the financial statements are reissued unless the adjustment is required by US GAAP or regulatory requirements. Okay, I'll go back to slide number 10 here. So that is regarding reissuance of financial statements. So I'll go back to slide number 10, then we'll come back to the example 3. So going concern, slide number 10. So Ritupurna, let me know when you are finished, when you are done with this. Okay, I think we are done with the slide, so I can move on to the last example. Which one of the following events after the reporting date or reporting period provides the evidence of condition that existed at the end of the reporting period? So there are 4 events mentioned here. Foreign exchange fluctuation occurring after the reporting date, settlement of a legal claim outside court, fraud discovered, an announcement of plan to discontinue an operation line. So 4 events are there, which are post-balance sheet events, which we have to basically examine whether this events provide evidence of condition that existed at the end of the reporting period. So first one, foreign exchange fluctuation, it's a non-adjusting event, because changes in the foreign exchange rates after the reporting period are due to changes in the economic conditions after the reporting date. And this is a continuous event, because foreign exchange rates continuously change, the economic conditions keep on changing, so it's a continuous event. So one day's rate will be different from the next day, 1 hour, a particular time exchange rate at a particular hour can be different in the next hour, like that. So this is a continuous event, and this is due to economic conditions existing after the reporting date. So financial statements have already been adjusted for rates that existed on the reporting date as per IAS 21. So as per IAS 21, the financial statements, the translation, we talked about reporting currency, foreign currency, all this we talked about under IAS 21. Okay. So financial statements are already adjusted for exchange rates that existed on the reporting date as per IAS 21. So this post-balance sheet event of foreign exchange fluctuation is a non-adjusting event. Then second one, settlement of a legal claim outside court. It's an adjusting event. Because when a case is settled outside the court, uncertainty gets eliminated in respect of condition that existed at the end of the reporting date. At the end of the reporting date, the case was still pending, it was still not settled. But once it gets settled outside the court, uncertainty relating to the case, what you are going to lose or what are you going to win, what is the financial loss or financial gain, the uncertainty will get eliminated if the case is settled outside the court even after the reporting date. So, uncertainty gets eliminated in respect of conditions that existed at the end of the reporting date. Third one, frauds discovered. Again, it's an adjusting event. Fraud was perpetuated in the year under review. So when the fraud is discovered, although it was not known on the reporting date, because of the fraud, the company may suffer some losses. So the condition existed on the reporting date, only it was discovered subsequently. Since fraud was perpetuated in the year under review, so it will be considered adjusting event. Announcement of a plan to discontinuance of an operation line. See, non-adjusting event because the operation was not disposed of at the end of the reporting period. This operation cannot be classified as held for sale under IFRS 5 as there is no commitment to a plan at that time. So it will be considered a non-adjusting event. I am not talking of announcement of plan to liquidate the company. It's plan to discontinue operation line, one of the operations line. Okay. So this is if it is a plan to discontinue the business, then it's a adjusting event. So it has to be we cannot prepare even the financial statements on going concern basis. But when it's simply a announcement of a plan to discontinue operations line, it will be considered as non-adjusting event. The operation was not disposed of at the end of the reporting period. The operation therefore cannot be classified as held for sale under IFRS 5 as there is no commitment to a plan at that time. So this is a non-adjusting event. So these are the four examples we have looked at. So with this, we'll conclude the session on events of the reporting date, how that to be treated and all that. So events of the reporting date are basically those events which occur between the end of the reporting date and the date on which the financial statements are authorized for issue. There are basically two types of events: adjusting events, the events that provide further evidence of the conditions that existed at the end of the reporting date. These are called adjusting events, and for this kind of events, the financial statements have got to be reworked or adjusted. The numbers have to be changed. There are events that are indicative of the condition that come into existence after the end of the reporting period. These are basically non-adjusting events. If these events are material, then they should be disclosed by way of notes to financial statements, that much. But requires no adjustment or changes in the numbers in the financial statements already prepared. Okay. So we'll have a short break at this point of time, and then we'll discuss about price earning per share. That's another important concept which we'll explore in the next session. Welcome back after the break. There is an announcement. It's on your whiteboard. There will be no class on 17th May. For studio maintenance, there will be no class on that day. Your next class will be on 19th May. So please note that. Centers have already been informed. So you won't have any class on 17th. Next class will be on 19th, next Friday. Okay, so we'll talk about now earning per share. We'll define earnings, how the basic earning per share, two concepts are there, calculation of basic earning per share and diluted earning per share. And we'll talk about diluted earning per shares in different scenarios, the treatment and the accounting requirements and the difference between IFRS and US GAAP relating to this particular issue. The price earning ratio is a very important indicator of corporate performance. The price earning ratio of a company is a very important indicator for the investors. The users of the financial statements, particularly those who are investing, they look at this ratio. Now, price earning ratio is nothing but market price of the share divided by earning per share. So that way, there should be standards. Some standards have been set down or laid down in IFRS how to calculate earning per share, so that every corporate, they report their earning per share based on those standards. So a key component of the P ratio is the denominator is earning per share. PE, P by E basically means market price divided by earning per share. Now, P by E ratio is a very important indicator for the investors, for the users of the financial statements, and the key component of the P ratio is the earning per share. So there is a accounting standard IS 33 which lays down certain standards based on which the company will report their earning per share. In the financial statement, the earning per share is also reported by the companies. So how it is to be calculated? So IS 33 basically enhances financial reporting by ensuring that there is consistency in the calculation of the earning per share statistic to bring comparability in the EPS. Now IS 33 provides for calculation method, determining the number of shares to be used in the computation, accounting and presentation requirements. So we'll talk about IS 33 in this particular lesson. So we have to understand a few concepts here. As per IS 33, there are certain concepts which you have to become familiar with. One is the ordinary shares. Ordinary shares are equity instruments which are subordinate to all other classes of equity instruments. They are called ordinary shares. They are also referred to as common shares. So ordinary shares are basically shares, equity shares, which are subordinate to all other classes of equity instruments. They are also referred to as common shares. So ordinary shareholder actually participate in the profit for the period only after the other types of shares such as preferred shares have participated. So when a company earns a profit, preferred shareholders have a preference in the participation of profit or getting dividend out of the profit. After they have received the dividends on the preferred shares, then whatever is left is available to the ordinary shareholders. So they participate in profit for a particular accounting period only after other types of shares such as preferred shares have participated. An entity can have more than one class of ordinary share. For example, if an entity has two classes of common shares, class X and class Y, if class X is entitled to a fixed dividends of $10 per share, Class A dividend of 5% and Class Y is entitled to a dividend of 5% only. Then Class X shares are not ordinary shares because they are entitled to a fixed dividend of $10 per share. It creates a preference over Class Y shares. So Class Y shares will be subordinate to Class X shares. Okay, Rituparna wants me to go back to the idea slide. Okay, that is the opening slide. I will go back for a minute. So tell me when you are finished with the slide. Then I will again discuss what we mean by ordinary or common shares. So please tell me when you are done. This is only the agenda of this session. Okay. The equity instruments which are subordinate to all other classes of equity instruments, they are called ordinary shares or common shares. So there can be a company can issue preference shares, a company can issue common shares. So common shares are always subordinate to the preference shares because the participation in the profit or declaration of dividend from the profit will be made first to the preference shareholders. If anything is left after that, it will be available to the ordinary shareholders. So their participation in profit is subordinate to the preference shareholders' participation in profit. Even for company having more than one class of ordinary shares, like say entity A has two classes of common shares, Class X and Class Y. If Class X shareholders are entitled to a fixed dividend of $10 per share plus A, another dividend of 5%, and Class Y is entitled to a dividend of 5% only, then naturally Class X shares are not ordinary shares, as the fixed dividend per share of $10 creates a preference over the Class Y shares. So Class Y shares will be considered as subordinate to Class X shares, and this will be considered as ordinary shares. Then another concept is potential ordinary shares. Financial instruments or other contracts that may entitle their holder to ordinary shares. For example, convertible debt, convertible preferred shares, share options, share warrants, share purchase plans, and contingently issuable shares are termed as potential ordinary shares. They are not yet shares. They are financial instruments or contracts which may entitle their holder to issuance of ordinary shares. Like a convertible debenture holder may be entitled to issuance of ordinary shares when the conversion takes place on a future date. Convertible preferred shares, share options or share warrants entitle the holder of the options or the holder of the warrant to get shares issued in their name on a future date when the options or the warrants are exercised. Share purchase plans and contingently issuable shares, these are termed as potential ordinary shares, although they are not really ordinary shares. Ordinary shares have not yet been issued to the holders, but they can become ordinary shares. They are potential ordinary shares. They can be converted into ordinary shares. And dilution is another key concept, which means the reduction in earnings per share or increase in the loss per share resulting from the assumption that potential ordinary shares will materialize. So if we assume that the potential ordinary shares are going to materialize, then the reduction in the earning per share or increase in the loss per share resulting from that assumption that potential ordinary shares will materialize or will get converted into ordinary shares, that is called dilution. So there are three very important concepts here under IS 33. One is the concept of ordinary shares. That means equity instruments which are subordinate to all other classes of equity instruments. Then potential ordinary shares, basically financial instruments or other contracts that may entitle their holder to ordinary shares. And dilution, the reduction in earnings per share or increase in the loss per share resulting from the assumption that potential ordinary shares will materialize. So these are the three very important concepts under IS 33, and based on these concepts, earning per share, diluted earning per, basic earning per share, diluted earning per share, etc. are calculated. Dilution means, supposing a company, I am giving an example. A company, I am happy that you are asking a question today, Madhuri. Say a company has issued 1 crore of ordinary shares and they have issued also non-convertible debentures, which entitle the holder of the debentures to get this converted into, let's say, another 10 lakhs of ordinary shares. So company has number of ordinary shares is 1 crore ordinary shares. Company has issued 1 lakh non-convertible convertible debentures or convertible bonds. Debentures are debt instruments. Okay, they have issued 1 lakh of convertible debentures, which can be converted into, each debenture can be converted into 10 ordinary shares. So it can be converted into 10 lakhs ordinary shares on a future date. A company has raised capital by issuing 1 crore of ordinary shares. They have also raised capital by issuing 1 lakh of non-convertible debentures. The terms of the debenture is that each debenture holder is entitled to 10 ordinary shares. When the debenture is going to be redeemed in future, instead of paying back the money, the company will issue 10 ordinary shares to each debenture, against each debenture. So 10 lakh of potential ordinary shares are there. So the number of potential ordinary shares is 10 lakh. And actual number of ordinary shares is 1 crore. Now supposing the company has earned a profit after paying dividends to the preferred shareholders, etc. Company's profit is, let's say company's profit is 1 crore. Now if we take dilution into account, then this profit must be divided by what is the number of shares we will consider. If we consider dilution, if we do not consider dilution, that means if we do not assume that these debentures have been converted into ordinary shares, our basic earning per share will be 1 crore of profit divided by 1 crore ordinary shares issued, so 1 rupee earning per share. But if we consider dilution, then we take the number of shares as 1 crore plus 10 lakhs, so 1.1 crores. So as a result, the diluted earning per share will be 1 crore divided by 1.1, which will be less than 1 rupee per share. This is dilution. Dilution is basically when you assume that the potentially ordinary shares will materialize or will get converted into ordinary shares. So you increase the number of shares that way. That will reduce the earning per share. That is the meaning of dilution. So we'll see some examples. Right now we'll look at some examples. So these things will be more clear to you when you look at some of the workings or calculation of basic earning per share and diluted earning per share in different scenario. I hope if you have not, it is still not clear to you, then when you look at the various examples which will follow, it will become much more clear to you. But basically dilution means we are not considering only the ordinary shares which have been issued, but we are also considering the potential ordinary shares. Our assumption is that the potential ordinary shares will materialize, that means they will be converted into ordinary shares. If we take that situation, then there will be reduction in the earnings per share or an increase in the loss per earning per share. So let's look at some examples, then it will be more clear. Anti-dilution. Now talked of dilution. Anti-dilution is the increase in EPS resulting from the same assumption. If the EPS increases from the same assumption, then it is called anti-dilution. If the EPS decreases or the loss increases per share, that is called dilution. If the EPS increases resulting from the same assumption, it will be considered anti-dilution. We'll see examples of that. Now there are two types of earnings per share, which is BEPS, basic earning per share, based on the existing earnings, and outstanding common or ordinary shares. So basic EPS is calculated based on the existing earning, that is profit, and the total number of outstanding or common ordinary shares. Outstanding, common or ordinary shares. DEPS is calculated as a cautionary measure to an existing shareholder or as a conservative measure of the earning accruing to each share. It includes potential ordinary shares also in the calculation of EPS, hence diluting the EPS. For example, the instruments are actually converted into shares or options are exercised, resulting in additional shares being issued. So diluted EPS when you calculate, it's a basically conservative measure of the earning accruing to each share. So we are assuming that the instruments which are potential ordinary shares are actually converted into shares or options available to shareholders or warrants available to the warrant holders are exercised, resulting in additional shares being issued. So for calculation of DEPS, not only the outstanding common or ordinary shares will be taken into account in the denominator, but also the potential ordinary shares will be added for calculating the EPS or for diluting the EPS. The standard basically focuses on two types of EPS calculation, and both types of EPS calculation have to be reported through the financial statements. The standard focuses on two types of EPS calculation, basic EPS and diluted EPS. Basic EPS is calculated by dividing the profit or loss attributable to the ordinary shareholders. We take the profit or loss which is only attributable to the ordinary shareholders by the weighted average number of ordinary shares outstanding during the accounting period. Now I will explain again what is weighted average number of ordinary shares outstanding during the accounting period. Supposing during accounting period, at the beginning of the accounting period, the company had 1 crore of ordinary shares issued. During the accounting period, the company issued another 1 crore of shares maybe after 6 months. So what is the weighted average number of ordinary shares during the accounting period? It will be the weighted average of this 1 crore of shares which were there for 12 months and for 6 months. So we have to take a weighted average. So for calculation of basic earning per share, we take in the numerator we take the profit or loss attributable to the ordinary shareholders and divide it by the weighted average number of ordinary shares outstanding during the accounting period. That's how the BEPS is calculated. For calculation of DEPS, it shows the effect on earning per shares of all dilutive potential ordinary shares that are outstanding during the year. So we have to add. In the numerator we are taking earlier the weighted average number of ordinary shares outstanding during the accounting period. So we will now consider also the dilutive potential ordinary shares which are outstanding during the accounting period. Now coming to basic EPS, how calculation is done. An entity is required to present the basic EPS for profit or loss attributable to the ordinary shareholders. Profit or loss relating to continuing operations attributable to those ordinary shareholders adjusted for post-tax effect of preference dividends and non-controlling interest. So basically we are looking at profit and loss relating to ordinary shareholders or attributable to the ordinary shareholders, divided by weighted average number of ordinary shares outstanding in the period. So earnings are calculated as the amount attributable to the ordinary equity holders in respect of profit or loss from continuing operations and net profit or loss, that is profit after tax, less cumulative preference dividend for the period. So basically we have to subtract from the profit and loss attributable to the ordinary equity holders in respect of profit or loss from continuing operations. So profit after tax we add it to the cumulative preference dividend, reduce it by preference dividend for the period, not prior period. Any preference dividend of the prior period would not be adjusted. Only preference dividend for that particular accounting period, whether declared or not, should be reduced from the PAT. So PAT minus cumulative preference dividend for that accounting period, whether declared or not, reduced by non-cumulative preference dividend declared for the period. For non-cumulative preference dividend, if it is only declared, then it will be subtracted. If it is not declared, it will not be subtracted. And other adjustments relating to preference shares will be made and divided by the weighted average of the ordinary shares issued and outstanding during the accounting period. So let's look at some example here to understand BEPS. Example makes things very clear. So how we calculate the weighted average number of ordinary shares during the accounting period? So we take the number of ordinary shares at the beginning of the period. We add the number of shares issued during the period, that is, and less number of shares brought back in the period. Company can buy back the shares also. So the number of shares which are outstanding at the end of the accounting period is basically number of ordinary shares at the beginning of the period. You have to add number of shares which are issued during the accounting period, and number of shares you have to reduce it by number of shares bought back in the period. So shares issued and bought back are multiplied by a time weighting factor depending on when the event took place, when the event of issuance of share took place and when the event of buyback of share took place. Partly paid up shares. Sometimes shares are partly paid up. That means the full amount of money that is to be paid by the shareholder for issuance of the share may not have been paid, only a part has been paid. So partly paid shares are included as fractional shares to the extent that they are entitled to participate in dividend during the period relative to a fully paid ordinary share. So shares are normally included from the date the consideration is receivable. From which date we will recognize the shares have been issued? From the date when the consideration is receivable by the share issuing company. Contingently issuable shares are included when the condition have been satisfied, not otherwise. Contingently issued shares will be only added when the conditions have been satisfied. So let's look at an example in the next slide to understand the calculation of the weighted number of shares and related earnings for BEPS. Entity A has a profit after tax of 15 million for the year ended December 31st, 2015. Those appropriations of profit have not been included in this. The following appropriations of profit have not been included in the amount of 15 million. Amount of cumulative preference dividend for 2 years ended December 31, 2015 is 4 million. Ordinary dividends is 5 million. Preference share premium payable on redemption out of appropriation of profit is 1 million. Exceptional profit net of tax is 4 million. So these appropriations of profit is not included in the amount of 15 million. 15 million is the profit after tax for the year ended December 31, 2015. Out of this, areas of cumulative preference dividend for 2 years ending December 31st, 2015 is 4 million. That means for 1 year, that is for the year ended December 31st, 2015, for 1 year it is 2 million. Ordinary dividends declared, paid out of this profit or declared out of this profit is 5 million. Preference share premium payable on redemption out of the appropriation of profit is 1 million. And exceptional profit net of tax is 4 million. So how will we calculate the earnings for the purpose of BEPS? Further facts. We have not completed the facts of the case. First we look at the earnings. Now look at the share transactions occurred during the year ended December 31st, 2015. The entity had 3 million ordinary shares of $1 outstanding at January 1, 2015. On 1st of January 2015, the entity issued 250,000 shares at $5 per share. So basically they received 250,000 by issuing shares at $5 per shares, $1 paid to date. That is on 1st Jan 2015, $1 has been paid by the shareholders, partly paid. Entitled, these partly paid shares are entitled to participate in dividends to the extent paid up. That means 20%. The shares are priced at $5, $1 has been partly paid. So those shareholders, they are entitled to participate in the dividends to the extent of the paid up value, that is $1 out of 5, 20%. On 1st of April, company issued shares, 200,000 shares at full market price of $3 per share issue. So 200,000 shares are issued and 600,000 was received from those investors who bought those shares. On 1st of July, 400,000 purchase of own shares at $3.50 per share was made by the company. Company bought back its own shares at $3.50 per share. 400,000 was. Now calculate basic earning per share. Now let's look at first the earning, how to adjust the earning. Profit after tax is 15 million plus exceptional profit is 4 million. The total profit is 19 million. Less preference dividends only current year. For cumulative preference dividends only for the current year, whether declared or not, should be subtracted. So less preference dividend current year only is 2 million because total dividend, cumulative dividend declared for this for 2 years, 4 million. So for 1 year, for the current year, it is 2 million. Less preference share appropriation, 1 million. So profit available to the ordinary shareholders is 16 million. 15 plus 4 minus 2 minus 1. That is the profit we have to consider for the calculation of the BEPS. So we are adjusting the profit after tax, adding the exceptional profit to it. So 15 plus 4. We are reducing it by the preference dividend for the current year on the cumulative preference share, that is 2 million. We are reducing it also by the preference share appropriation on redemption 1 million. So the total profit available for the or attributable to the ordinary shareholders is 16 million. Is this clear to everyone? Then we go into how many ordinary shares, weighted average number of ordinary shares are issued and outstanding. That is, we will go to the denominator. We have already worked with the numerator. Numerator is 16 million. Is that clear or any doubts? Yes. Madhuri, any doubts you have got? Okay, fine. So this is how the numerator is calculated. Basically, we adjust the profit after tax. So you reduce it by, add an exceptional profit and then reduce it by the payments which are due to the preference shareholders for the year. So cumulative preference shares, whatever dividend, whether it is declared or not, that will has to be adjusted. Similarly, for redemption of preference shares, if any amount is payable, any premium is payable, that has to be adjusted. So profit available for ordinary shareholders is 16 million. Now let's look at what is the weighted average number of ordinary shares issued and outstanding during that accounting period. Company had issued, we have seen it, earlier the company had 3 million ordinary shares are outstanding, each of $1 are outstanding at the beginning of January 1st, 2015. So 1st January, number of shares were 3 million, that basically 3,000. So we'll expressing everything in 1,000. So that will get a weightage of 12 by 12 because these shares were issued and available for the entire 12 months. So they will get a weightage of 12 by 12. On 1st January, company issued 250,000 shares, but these are partly paid up. 1/5 has been paid. So 250,000 into 1 by 5. This also get a weightage of 12 by 12. So when you multiply 3,000 by the weightage of 12 by 12, we get 3,000. That is the that will go into the weighted average calculation. This 250,000 shares, when you multiply it by, first we take the fractional, because they are partly paid of shares, only 1/5 has been paid. So you multiply it by 1/5, and the weighting factor is 12/12 because these are issued on 1st January and were there for the entire year. So 12/12, so 50 is the calculation that goes into the weighted average calculation. Then on 1st of April, the dates here are given as per American dating system. So 1st of April, company issued 600,000 shares. Okay, and the weightage is 9 months. The shares were issued in 1st of April, so till 31st December, only 9 months out of 12. The weighting factor will be, time weighting factor will be 9/12. So when you multiply 600 into 9/12, we get 450. And on 1st of July, the company bought back 400,000 shares, repurchased 400,000 shares. So that is a reduction in the number of shares. So this gets a weightage of 6/12 because the event took place on 1st of July, in the middle of the year. So when you multiply 400 into 6/12, we get minus 200. So the total number, the weighted average number of ordinary shares is 3,000 plus 50 plus 450 minus 200. So 3,300 is the weighted average number of ordinary shares issued and outstanding during the accounting period. So basic earning per share will be 16 million divided by 3,300. So it becomes $4.85 per share. That is how basic earning per shares are calculated. Is that clear to everyone? So we have seen the calculation, how we adjust the PAT, add the exceptional profit which is not included in the PAT, then adjust for the preference dividend or payment to the preference shareholders by way of redemption premium. Then we get what is the profit attributable to the ordinary shareholders. Now we calculate the weighted average number of ordinary shares outstanding during the year by taking into account the various events of share transaction. So how many shares are, ordinary shares are outstanding at the beginning of the accounting period, and then taking into account the issuance of shares or buyback of shares which take place at different points of time, and we use an appropriate time weighting factor to arrive at the weighted average number of ordinary shares which are issued and outstanding during the accounting year. That is our denominator. I hope this is clear to all of you. The example is very illustrative, so I don't think after this example you should have much doubts about how to calculate BEPS. Any questions you can ask me before I move to diluted EPS. Next we will talk about diluted EPS. We have talked about the basic earning per share. Now we will talk about diluted EPS, how it is calculated as per IAS 33. Any questions? Please come up with that. Any doubts? Please get it clarified. That's my request to all of you. If doubts still persist in your mind, please come up with your doubts. 400, remember, so I'll go back to that information again, okay? On 1st July, company purchased own shares. This is called buyback of shares. So 400,000 shares were purchased back by the company. They paid $3.50 per share from the willing shareholders who were willing to sell the shares back to the company. So it's a buyback of shares. When a company buys back its own shares, they have to pay to the shareholders who are offering the shares on buyback. So the number of shares will go down, isn't it? When a company buys back 400,000 shares from its shareholders, the total number of issued and outstanding ordinary shares will go down. This 400 is basically 400,000 shares which were bought back by the company on 1st of July, paying $3.50 per share. Is that clear? That is the information. On 1st of July, the company bought back 400,000 shares. So any other doubts you have, please have it clarified before we discuss diluted EPS. Okay. Now we'll talk about diluted EPS. So once we understand how BEPS is calculated in diluted EPS, will require some more refinements. Diluted EPS is calculated by adjusting the earnings and number of shares. You have to adjust the earnings and also the number of shares for the effects of the dilutive options and other dilutive potential ordinary shares. So you have to not only adjust the number of shares, not only adjust the denominator but also the numerator. You have to adjust the earnings which you have used for calculation of BPS and the number of shares which you have used for the calculation of BPS. You have to adjust them to give effect to the dilutive options or other dilutive potential ordinary shares. So DPS is calculated using a new number of shares and an earning figure. Now what will be the new earning figure? We have used the earning figure earlier by making adjustment for the preference, dividend, etc. But how the new earning figure will be worked out? New earning will be profit or loss attributable to ordinary shareholders. Same concept. But it is used in basic EPS calculation, is adjusted for after tax effect on potential ordinary shares, that is added back. So any dividend on dilutive potential ordinary shares will be added back. If any dividend is, supposing there is a class of shareholders, preferred shareholders, convertible preferred shareholders, and any dividend has been paid during the year to those preferred shareholders, that will be added back. That will be adjusted for after tax effect. So any dividend on dilutive potential ordinary shares will be added back. Interest in the period for dilutive potential ordinary shares, supposing some convertible debentures are there, which are basically potential ordinary shares. So when you dilute this, so whatever interest has been paid to the debenture holder, that has to be added back post-tax, on a post-tax basis to the earning. Any other changes in profit or loss that would result from the conversion of the dilutive potential ordinary shares. So assuming that the dilutive potential ordinary shares have been converted, if they are converted, we would not be required to pay the interest to those debenture holders. So whatever interest has been paid to the debenture holders should be added back on a post-tax basis. Whatever dividends have been paid to the convertible preferred shareholders will be added back again on post-tax basis. Okay. So we have to do the post-tax effect, after-tax effect, for add back any dividend on dilutive potential ordinary shares, interest in the period for dilutive potential ordinary shares like convertible debentures, convertible bonds, any other changes in profit or loss that will result from the conversion of the dilutive potential ordinary shares. So in calculating diluted earning per share, there will be adjustment to both the earnings and to the per share part of the statistic. If the potentially ordinary shares have given rise to any income or expense in the period, then its effect on profit has to be reversed. If the potential ordinary shares have given rise to any income or expense in the accounting period, then its effect on the profit has to be reversed on a post-tax basis. As the assumption is that it has now been converted into ordinary shares that would not have given rise to that income or expense. Because we are assuming that these dilutive potential ordinary shares have been converted into ordinary shares. So since they have been converted into ordinary shares, those income or expenses would not have arisen. So you have to add back or basically reverse the effect of this income or expenses on the profit after tax. So we'll look at an example to understand this better. We have this following information available on 1st of January. Shares issued are 1 million. And profit for the year ended 31st December is 200,000. So the number of ordinary shares issued is 1 million. And profit for the year ended 31st December is 200,000. On 31st March, the entity issues 200,000 6% convertible bonds with the following terms of conversion. 100 shares will be converted against $100. If conversion takes place within 5 years, then 100 shares will be issued for every $100 of the amount of the bond. If the Conversion takes place after 5 years. 110 shares will be issued against every $100 of debt. Tax rate is 33%. Basic EPS is, calculation is very simple, 200,000 divided by 1 million, because there has been no other share issue during the year. So the total number, so the weighted average number of common shares during the year is 1 million. There have been no other share issue. So 200,000 divided by 1 million. So $0.2 per share is the basic EPS. So you have to now calculate diluted EPS. Now, assuming the conversion takes place, we'll look at the terms of conversion when maximum number of shares are issued. So we'll consider that 10 shares are issued against $100. So there are two terms of conversion: 100 shares against $100 of debt or non-convertible debenture amount, and 110 shares against $100 of non-convertible debenture after 5 years. So we'll take the one that will result. The assumption we'll consider is that it is after 5 years. That means against $100 of non-convertible debt or convertible debt, 110 shares are issued. That we will take. So we'll see the calculation. So the basic EPS calculation we have already seen. For the basic EPS calculation, number of shares we considered is 1 million, and the profit earning we calculated is 200,000. Now we have to adjust both the earnings and the number of shares. Now dilution, how much dilution will take place? 200,000 is the amount raised through convertible debt. So for every $100, 110 shares will be issued. So, but this convertible debt instruments are issued on what date? They are issued on 31st March. So what will be the time waiting factor? 1 quarter is already over, so time waiting factor, that's 3 months is already over. So time waiting factor will apply is 9 by 12. So 200,000 divided by 100, because for each $100 of convertible debt, 110 shares are going to be issued. So 200,000 divided by 100 into 110 into the time waiting factor 9 by 12. So that gives us the dilution effect on the diluted number of diluted share as 165,000. So we are using the time waiting factor also because this convertible debt was issued on 31st March, that is at the end of first 3 months. So the time waiting factor will be 9 by 12. And $200,000 of convertible debt, this will be converted into how many shares? We will take the most unfavorable thing, that means 110 shares will be issued against $100 of non-convertible debt. So 200,000 by 100 into 110 into 9 by 12 gives you 165,000. That will be the increase effect of the dilution or dilutive effect on the number of shares. What happens to the earnings? Now this convertible debt carries interest of 6%. They have been issued on 31st March. So how much interest expense is related to this convertible debt? 200,000 into 6% into 9 by 12. That is the expense related to the convertible debt, but we will have to take the after-tax effect, how it will affect the after-tax profit. So you have to multiply it by 1 minus the tax rate, so which is 0.33. So 0.67 will multiply by it to get the after-tax effect on profit of this expense. If we disregard this expense, because the assumption is that the convertible debts have been converted into ordinary shares, so the expense related to the convertible debt has to be added back to the profit on a post-tax basis. So 200,000 into 6% in 9 by 12 is the interest payable to the convertible debt holders. That is the expense related to the convertible debt multiplied by 1 minus the tax rate, which is 33%, so 0.67. So the effect on income will be, earning will be 6,030. The income goes up by, because this is added back to the profit, so income goes up to 206. Effect of dilution, the income now becomes, earning becomes 206,030, and the number of ordinary shares due to dilution will be 1165000. So the diluted earning per share will be 206,030 by 1165000, 17.68 cents. So this is the way we have to make it for arriving at the DPS from the BPS, from the basic earning per share. If we want to go to calculation of the diluted earning per share, we have to make adjustments both in the earning. For the income and expenses related to the potential ordinary shares, you have to make adjustments. Similarly, you have to make adjustments to the number of ordinary shares, taking into account that the potential ordinary shares have been converted, with the assumption that potential ordinary shares have been converted into ordinary shares. That is how diluted EPS is calculated. Is this clear to you, or if you have doubts, please ask me the question. If you have any doubts, please clarify it at this point of time, because we can go to another example, or we can discuss another example of similar kind regarding diluted earning per share. But before that, I must be sure that you have understood this particular example, which is a comparatively simpler one. I am not getting any response from your side whether you have understood or not. If you have any doubts, please get it clarified. This is the time to get it clarified, so please get it clarified. So no doubts appear, apparently no doubts. If you don't have any doubts, I'll be happy. Okay, fine, because then you have understood. If you have doubts also, I'll be happy to provide the clarification. Anyway, I will request you to complete your feedback in the meantime. I'm still waiting for your queries, if any. Please complete your feedback in the meanwhile. Thank you for completing your feedback. I'm still waiting for any questions that you have still in your mind. Any particular thing I have not understood. So please come up with that. There will be another example which we will be discussing on the next session. I will leave it for the next session. Another example of how to calculate diluted earning per share with different example that we'll see in the next session. But if you have any doubts regarding the calculation of DEPS in this particular example, please come up with that. Please keep in mind that we have to do adjustments to both the figure of earnings and the number of ordinary shares which we have used for calculation of basic earning per share. So same numbers will not apply. So the earnings have to be adjusted for any income or expenses which can be attributed to the potential ordinary shares, any income or expenses which have been included in the calculation of profit or earning, which are arising from those potential ordinary shares. So that has to be adjusted in the profit figure, earning figure. And the second one is the number of shares also have to be adjusted to give the effect of dilution. So since there are no questions coming up, we'll close the session today, and your next session will be on 19th. Okay, 19th of May.